everyone. This is Gina Lofton, and I'm the host of the Accredited to Accredited show. We help high net worth individuals build more wealth. I have an amazing gentleman with me today, Adrian Day, and he is actually coming in from the DC area, New York, East Coast. So I'm going to bridge him in and let him talk to you about what he does and how he works with clients just like yourself to build more wealth. Okay, Adrian, I'm passing it over to you right now.
Well, thank you very much, and I'm happy to be here. So what we do, we're a registered investment advisor. We basically manage accounts for people, primarily in public and pre-public assets. So we don't do assets that are private and intend staying private, but we do pre-public. And we manage accounts on a totally discretionary basis and an individualized basis, meaning every account is different depending on the personal circumstances, their goals, their tax considerations and everything else. So that's what we do. We manage accounts globally, so we have stocks, around the world in many, many different countries. We're market cap agnostic, meaning market cap doesn't really matter to us as a criterion for making an investment decision. So we own Nestle, for example, and we own companies that are $1 and $2 million. Market cap comes into the entire structure of a portfolio because obviously a larger market cap gives you more liquidity. So we would not have a portfolio consisting exclusively of microcaps. But sometimes microcaps give you better value because they fly under the radar of many firms and more upside potential, more growth. So anyway, that's what we do. We have very low minimums, essentially no minimums. Whatever makes sense for a client. Our stated minimum is $500,000 for global investments and $200,000 for dedicated gold and resource accounts, which is a specialty of ours. But as I say, we're prepared to take less than that if it makes sense for the client.
Absolutely, Adrian. And that's really important because what happens is sometimes a lot of those typical asset management companies on Wall Street don't go into the smaller, let's just say, market cap companies. And I really want people to understand the uniqueness of what you can offer versus what the normal, let's just say, big, investment banking group does.
Well, that's absolutely true. And of course, investing in microcaps has the upside I've mentioned. It obviously has potential downsides as well. One I mentioned is liquidity, and that's particularly important because when you're investing in microcaps, if there's a microcap I really like and I want to buy it for a lot of different clients, you can get to the 5 and 10% limits very, very quickly, reporting limits. We avoid going over 20% because with 20% you have to give advance notice of sales, and we can't do that for clients. Obviously, you have to preserve the ability to sell immediately for clients. But we do have stocks where we own over 19%. Now, obviously, if you have a microcap and you own 19%, and you change your mind, it can be difficult to sell the stock. It takes time to sell the stock.
Right.
And so typically, I hope this doesn't sound flippant, but you can buy a Nestle one day, and if you change your mind the next day, you just blow it out and you've lost $1. You don't do that with a microcap, obviously. So we put a lot of time and effort into the due diligence, into investigating the companies before we decide to buy. The smaller they are, the more important that is. The other thing I think I should mention, because it's important, you talk about the big firms. A lot of money management firms will what I call invest to a model. Now, there's nothing wrong with that. What it means is when a new client comes on, they say, I want, to be US conservative or global aggressive or whatever it is. Once you've decided your objective, the firm immediately buys for you everything that is in existing clients' accounts. And if, for example, they bought Franco Nevada at $15 with a 5% position, and it's now, $88, and it's a 12% position, you get 12% of Franco Nevada immediately. So your account is exactly the same as everybody else. Now, that has benefits. Apart from being easier for the manager, it has a benefit for the client in that your performance is exactly the same as everyone else's performance in that category, and you don't miss out on stocks. I don't do that for a lot of reasons. So I'm not saying one way is absolutely better than the other. We don't do that. We first of all, we personalize accounts, as I mentioned earlier. And that can be a lot of things. You can say, I don't want tobacco. You can say, I don't want tax losses, whatever. But it also means that we tend, as value investors, we don't buy stocks, even if other clients hold them. We don't buy stocks we think are now overpriced. And I think you understand, particularly with big cap stocks, you can like a stock, it's become overvalued, but it's got momentum, so you don't want to sell it. And this is certainly true in this market. So you hold stocks, and that's a perfectly valid decision. But for a new investor, you might say, you know what, I'm not going to buy this for that investor, or I might just buy a little bit, but I'm not going to buy such a big position. That's number one. Number two is when you invest in microcaps, the truth is, Gina, we simply cannot buy some of these stocks for every client. There isn't enough liquidity. We can't do it. Yeah. And we don't want to buy, we don't want to buy $500 worth of a stock for every client. Yeah. So you want clients to have meaningful positions. And what that means is that different clients have different stocks in many cases. And so the performance can be different. I think that's worth pointing out to people. Yeah. Now, obviously, we try to, when we're investing and deciding who to buy for, we obviously look for the people that are most appropriate. Yeah. Anyway, enough on that.
Well, thank you so much, Adrian. So when we were in Jekyll Island a few weeks ago, you had an amazing presentation, and I thought that it would really resonate with this audience, because some people don't understand this kind of natural resources and mining area and that environment in that industry. So I was hoping maybe you can kind of give a little bit of that, that presentation that you went through last at Jekyll Island.
Okay, Gina. Now I'll skip over a few things and try to make it fairly concise. The Jekyll Island conference, by the way, was just an excellent conference, I thought, put on by the Palisades Capital, I think they're called, but Palisades anyway. It's a very good conference for high net worth people. What I focused on at this conference, there were several speakers on gold mining stocks. What I focused on were some of the problems with the gold mining industry, with gold mining companies, with gold mining stocks. Let's just start by looking. You can see on this graph here the gold stocks are the black line at the bottom, and gold is the blue line at the top. I'm sorry. That's the S&P is in blue and gold is in black. I'm sorry. So first of all, I was showing that gold has outperformed the S&P broad stock market and outperformed fairly significantly. And yet, look at the amount of money that's been written off by the small gold mining industry, and this is since 2012. Astonishing amount of money written off by the gold mining industry. And in fact, this shows you the amount of written off by company. So apart from and it's interesting, Randgold and Polymetal, which are the two stocks that have outperformed gold, are the two with the lowest write-offs. Randgold has no write-offs. These are write-offs, by the way, not write-downs. And interestingly enough, they are also the two companies that do not overpay their executives. There was not exactly, but there was an almost counter correlation between the amount that executives are paid and the amount of write-offs and the performance of the stocks. Really quite astonishing. In fact, since 2010, gold mining companies have written off about 60% of all of the money that they spent on acquisitions, which is which is close to criminal in my mind. Elvis shows that. So
I'm sorry.
then when we go to the
I'm
sorry,
flabbergasted every time I see that screen, Adrian, about how much they've written off. It's just amazing.
Well, it's astonishing, especially when you think that these companies are buying assets that have been developed to some extent, but take another 2 or 3 years before they get into production. And if you're spending $1 billion on capital, it's probably, in many cases, another 4 or 5 years before they earn their money back. Yeah. So these acquisitions are being written off before they have even had a chance to make their money back. To me, it's absolutely astonishing, and it just is a reflection to me of the bad decisions that many of the mining companies have made. Now, there are exceptions. Franco Nevada, for example, Franco Nevada had over $1 billion in cash from 2010 to 2014, and investors were saying, why don't you spend the money? Why don't you spend the money? Well, they did the right thing in holding on to their money. 2015, 16, I think it's right to say, they went on a buying splurge when prices were down. Agnico's another one that seemed to work with the cycles and buy things when they were down. Anyway, if we go to the opposite end from producers to exploration companies, we have other problems. The biggest problem here is just how few big deposits are available. And Newmont did a study once, or analysis, that suggested that only 1 in 10,000 anomalies will ever become a 5 million ounce producer. Most of the major mining companies don't want to buy anything for less than 5 million. So that was their sort of benchmark. Obviously, if you're looking at smaller mines, you can cut that to 1 in 5,000, 1 in 3,000, depending on the size of the mine. And of course, we're talking about anomalies. Sometimes you look at an anomaly and then, you know, you move on a few weeks later because it doesn't look interesting. But it really is like looking for a needle in a haystack. And the problem also with juniors, exploration companies, is that they don't have any revenue, right? Yep. So if they're going to spend money exploring, looking for mines, they have to raise money. This is another astonishing chart. This is half a dozen companies that we own, right? So I'm not picking the worst companies out there. And look at the share counts over the last 12 months, how much they've increased. In one case, at the bottom, it's more than doubled in the last 12 months. Now, if the share count more than doubles in 12 months, it means the stock has to go up more than, the value of the company, has to go up more than 100% just for the share price to stay the same.
That's
right? With those share counts increasing.
They've been diluting the value to the shareholders.
Absolutely. And again, these are companies we own, so I would like to think there's some of the better companies out there. And so I asked the question, you know, how did that work out for you? Well, not too well, and not too well, and again, not too well. So when you dilute, again, what it means is that as a shareholder, I own less of the total of the company. And again, the company has to go up 50%, 100% just for my share to be worth the same. Now, I need to point out, sometimes companies do raise money and spend it properly. And here's a company called Cisco Mining. You can see a huge increase in their share count starting in the beginning of 2015, and the share count has gone from, you know, about what is that, about 10 million shares up to 132 million, 172, I'm sorry, my eyes aren't good, 187 million. Mm-hmm. So, but anyway, the point is anyone can see from the graph a huge increase and several raises. They've done multiple raises over those few years, but they put the money in the ground exploring. And you can see the share price reacted, and it reacted positively because they put the money in the ground and they found things. The problem with a lot of the companies I showed earlier is they raise money simply for G&A, simply to keep going. And so it's no surprise that, nothing comes of it. I want to end, if I may, on a positive note, just to get back to your earlier point. This shows gold versus the broad market. I showed it earlier. Gold has underperformed the broad market. And remember, when you're investing in gold, when you're investing in stocks, when you're investing in bonds, when you're investing in anything, that asset is competing for your money against every other asset. So when you look at stocks or bonds, you have to look at how do bonds compare with stocks? How do stocks compare with gold? How does gold compare with real estate, etc.? Everything is competing against other things. Gold has definitely underperformed over the last 5 years. But if gold has underperformed against the broad stock market, gold stocks have underperformed even more so. And this is gold stocks versus gold. So gold stocks are one of the few major asset classes that have actually declined over the last 5 years and have seriously underperformed. And it means that they're undervalued. This is gold stocks on a price basis. So certainly you can see from 2011 down to the bottom at the beginning of 2016, gold stocks were down over 70%. And this is the senior gold stocks. Many of the juniors were down 85, 90% in that time. So on a price basis, they're very undervalued. But on a value basis, they're also much, much closer to their lows than to their highs. This is on a book value, which is one good criterion with which to look at senior gold companies, in my mind. And you can see that despite the jump from 2016, they are still considerably lower than they were back in 2008, 9, 10, 11, and so on. Just another example, cash flow, which is another good way of looking at mining companies. I like to joke, we don't actually look at earnings because most of them don't have earnings, but we do look at cash flow. And again, you can see, despite the jump since 2015, they are still significantly undervalued relative to their longer term averages. And so I think that this represents the fourth major buying opportunity for gold stocks in the last 30 years. This goes back to 1985. It's been lots of squiggles in between, but if you look at the broad trends, up 150% in 2 years, up 100% in 4 years, up 300% in 5 years, I think we're just beginning that next major move. So I think this is a very, very good time to be buying gold stocks.
No, Adrian, this was great. I mean, I love deals and I love buying things when they're on the clearance rack, so to speak, and this looks like it's on sale. So if someone wants to get more information about what you can do for them, how are they able to do that?
Yeah, well, I'll give you a website, which is www.adriandayassetmanagement.com, or the phone number is 410-224-2037.
Excellent. Well,
and I'd be happy to send people information, of course. We're not high pressure people, by the way, and although obviously most of our clients are accredited, and that's what you're doing here, we do take people who are not accredited. Everyone has to start somewhere, right?
Yep. Absolutely.
And we like to help people who are just starting out and don't have a lot of money, because I think the way to build assets is to start early, or one way is to start early.
Absolutely. Well, I mean, Adrian, this has been phenomenal. I really appreciate everything that you've done to get my audience educated and up to speed quickly. I do want to ask maybe if I can have you again on the show in the new year, with your time. I know it's kind of tight, but we'll make sure to bring you back.
I'd love to. I'd love to.
Thank you so very much. And I will be seeing you in San Francisco, I believe.
Yes, I think I'm going.
Excellent.
Okay.
I look forward to it, okay?
And you.
Thank you so much.
I knew what I needed, so I went out and got it. Started stacking up assets, now I'm bringing in profits. I knew what I needed, so I went out and got it. Started stacking up assets, now I'm bringing in profits.